For a deeper dive, we welcome back Anthony Chan, former Chief Economist at JP Chase. Good to see you, my friend. It wasn't a good week last week. It wasn't a good start to the week this week. And I've heard both sides of the argument that why they should raise or should not raise. But it feels like there's something else happening in the marketplace other than rates. I want to get your take on today's movements.
Well, Phil, there is a concern that if the Federal Reserve continues to raise rates aggressively, that somehow they will break something. And by that, I mean that they can cause some sort of a hard landing. I think the market has come to terms with the risk of a soft landing and maybe even a mild recession, but they certainly don't want to see a severe and a hard landing recession that will cause a plunge in earnings, and therefore the recent run-up that we've seen in price-earnings ratios in the U.S. equity market won't be justified, and the market has to reset. And so right now, because of that risk, equity prices certainly have let some air out, just adjusting for the fact and the risk that somehow we can have a somewhat of a harder landing when it comes to a potential recession.
The expectations leading into the speech on Friday is about 75 basis points. I've heard 50, and I've heard a little less from others. But that decision doesn't come yet. The Fed's focus on fighting inflation, it seems to me that's not going to go away anytime soon. Does raising short-term rates continuously, is that going to have the desired effect that the Fed actually wants? Because I don't see how they're going to get it from 8% to 2% anytime soon.
Well, Phil, I think you're spot on. They're not going to get it from down from 8.5% on the CPI, or even a lower number if you're looking at the personal consumption deflator, down to 2% anytime soon. And by anytime soon, we're talking about a couple of months. But by raising short-term interest rates, they will slow the economy down. They just don't want to slow it down so quickly that it will cause a crash in the economy. My suspicion is that if they go about the process in a gradual fashion, inflation will come down, but not immediately. But even if it takes a year and a half, or even 2 years to get to 2%, by going at taking a gradual approach, they minimize the risk of a hard landing, and that the economy can somehow normalize a lot more gradually and less of a crash landing. And I think the market is concerned about it. But I do believe that right now the Federal Reserve is poised to raise interest rates another 75 basis points, and then look at the data to see if more is needed. But between now and almost the end of September, the third week in September when they meet, they've got more employment reports and they got more CPI reports, so they can tinker or adjust that expectation based on the incoming data. After all, Jerome Powell, the Fed chair, has told us that the Fed was going to be data dependent. So we have to look at the data to actually know what they're going to do.
So at minimum, the short-term impacts are if you raise rates, that is generally good for the stronger dollar. In other words, the dollar will keep getting stronger or stay strong. But there's also an impact to other currencies and countries that we trade with as well. What's the impact to our trading partners?
Well, it's clear that if the U.S. dollar gets stronger, they can't buy U.S. products as readily. So that gives a hit to the corporate profits in the United States. And of course, many of these other countries that have a lot of U.S. dollar debt, it makes it a little bit more challenging. Some of the emerging markets, for example, are going to face some challenges with a much stronger dollar. And again, those countries that buy a lot of U.S. products will have more challenges buying those products as their currency depreciates against the U.S. dollar. And we're, of course, seeing across the pond, we're seeing the British pound taking a big hit recently, despite the fact that they've been raising short-term interest rates because their inflation rate is even higher than that of the United States.
And then, of course, we care about this because ultimately it will impact corporations and their earnings, which so far the earnings, half of them have been fairly strong and the other half have been suspect at best. And I'm just wondering, as an economist, how do we do the future cash flow or discount whatever future earnings there might be in this kind of environment? I feel like there just seems to be more guessing right now.
Well, I think there is some guessing, but if you look at corporate profits, they are starting to ease, at least from an expectations point of view. If you look at the next 2 calendar quarters, analysts have been revising down those earnings. And yes, the earnings in the latest quarter came in above expectations. They always do. But right now, they're lowering those expectations for the next couple of quarters. And with that is the expectation that slower economic growth will generate slower earnings. And in an environment where earnings are moving lower, you can't justify rising price earnings ratios. So the current price earnings ratios have to be reset.
Well, maybe that's why the markets are selling off. Anthony, good to see you, my friend. Anthony Chan, former chief economist at JP Morgan Chase.